The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning and warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum here with Steve Sedgwick, and these are your headlines this morning. President Trump says he has fired Fed Governor Lisa Cook over mortgage allegations, but Cook hits back, saying the U.S. leader has no grounds to oust her.
France's government teeters once again after Francois Bayrou says he will put his budget cuts to a confidence vote. They love a confidence vote in France, with the three main opposition parties already saying they will vote against the Prime Minister. And President Trump threatens fresh tariffs on countries that tax or regulate U.S. tech firms, with the White House also reportedly even considering sanctions over the EU's Digital Services Act. Lovely to see you all. Under any normal day, we'd cover any of those big stories. Plus, I've got a dozen more for you. We've even got NVIDIA tomorrow as well. So there is so much going on. So it's a privilege to be in the news business and to have you all with us today as well. So thank you very much indeed for that. Let's get to, without doubt, our top story, which could have big ramifications, not just in DC, but throughout the entire bond market. Let's be honest about it. President Trump says he is firing Governor Lisa Cook from her position at the central bank, effective immediately. In a letter posted on his Truth Social account, Mr. Trump said there was sufficient evidence to believe Cook may have made false statements on mortgage agreements. Allegations the Department of Justice is investigating after a referral from the director of the Federal Housing Finance Agency, which is Mr. Pulte, I believe, who's an ally. A close ally of the president and vocal Fed critic. The president said he was removing Cook for cause, the only way he can fire a Fed board member under the laws governing the institution. In a statement, Lisa Cook, for her part, said there is no cause that exists under the law and Trump has no authority to fire her. She vowed to continue to carry out her duties at the Fed, saying she will not resign from her position. Now, if the president succeeds in his attempt to remove Cook and appoint a replacement, and if also Stephen Mirren is confirmed by the Senate to fill the vacancy left by Adriana Kugler, Trump appointees would now hold a 4-3 majority on the Fed's board. The board has the power to approve or reject the appointment of regional Fed presidents, with all of those up for renewal in February. Do you get this, ladies and gentlemen? What it means is you could actually have Trump pretty much appointees dominating the FOMC, which of course would dramatically change potentially the voting. We could then, it's not, I don't think, dramatic to say, see significantly lower interest rates, especially after May when, of course, Jay Powell vacates his position as well, which could really, really change a lot of things in the markets that we all cover. Democratic lawmakers have criticized the president's move, with the Senate Banking Committee ranking member Elizabeth Warren describing it as an authoritarian power grab, saying it must be overturned in court, whilst Republican Senator Rick Scott said Trump was doing the right thing to restore trust in the Fed and hold people accountable.
Let's get to the market action. Yesterday on Wall Street, it was a downbeat session for the major indices. You can see all three pulled back over the course of the day. The tech-heavy Nasdaq dropped about 22 basis points. The Dow Jones lost about 350 points or so, and the S&P also lost some ground. 9 out of 11 sectors were negative in the session, led to the downside by consumer staples. Now, interestingly, we did see a bounce in the greenback, the dollar index gaining about 0.7%. Now, in addition to the Fed story that Steve just outlined there, markets also this week bracing for NVIDIA results due out tomorrow. Could be a major market moving set of numbers. Now, in terms of the Asian trade overnight, stocks generally lower as well, modestly in terms of the magnitude there, following the downbeat session on Wall Street. Nikkei 225 down 0.9%, a bit of a pullback over in Hong Kong, as well as in Shanghai after outperformance in the China region yesterday. In terms of European futures, today is the first day of trade for the FTSE 100 this week after being closed yesterday for the bank holiday, so we'll keep a close eye on the UK market Also on the French market, yesterday we saw a major underperformance from the French market, the CAC 40 dropping about 1.6%. The story there, the French Prime Minister unexpectedly calling for a confidence vote on September 8th. This took the market by surprise in terms of the timing here, and we saw a major negative reaction in stocks. We saw yields move higher. There you have the 10-year French government bond trading right now around 3.51%. For context, 10-year BTPs trading around 3.61%.
Eric Nelson is macro strategist at Wells Fargo. Good morning, Mr. Nelson. How are you, sir?
Well, and you?
I am well. Should we be concerned about the firing of Lisa Cook?
In a short answer, yes. It's absolutely we should be concerned. And the question is, how does this play out, right? So the odds of this going to Supreme Court are pretty substantial. And if that's the case, then we're probably looking at a decisive decision out of the Supreme Court in terms of what this means for, as you alluded to earlier, other people on the FOMC. Are we going to see more infiltration from the executive branch into the Fed? Now, I think the market is not taken completely off guard by this, right? We've been talking about Fed independence all year, hence why I think the dollar is down only slightly. I think what it does put at risk, though, is the incredible tightness in financial, credit spreads, the rally in equities. Markets are priced for a lot of good news here, and there's the notion that this is somehow positive for stocks because rates go down, I think is completely misguided.
What do Republicans who think this is a good idea think about the fact that in a New York civil fraud trial last year, Donald Trump was ruled against for massively inflating the value of Trump Organization properties in order to secure favorable loans? Is there a massive degree of hypocrisy that a man who's had a ruling against him in New York has got allies now who are saying that Lisa Cook must resign for an unproven allegation at this moment that hasn't been tested in court?
Yeah, the issue here is to see Republicans rallying around Trump's decision is really concerning because it shows that there is a widespread effort here to damage Fed independence and Fed credibility. Right? It's not just single person, obviously an important person in Trump, going on a crusade. He's got the backing of the whole of, well, maybe not the whole of, but substantial amounts of lawmakers. That just emboldens him further, and it suggests that Cook is probably not the last person to be targeted here.
My problem here is I actually believe the central bank is as independent as it can be. There is no such thing as full independence of a central bank. We all know that. We see how they come to the rescue every time a government is too profligate as well. But I think it's as independent pretty much as it can be under Jay Powell as well. The ramifications for the US economy, if you have a bond market which is in free fall because there is a lack of trust in the central bank's ability to control inflation and therefore control markets afterwards, because if inflation gets out of the bag, then of course market movements thereafter, not only in the bond market but other asset classes as well, could be dramatic as well. Why are people being so myopic not to see the sequence of events that could happen?
Yeah, well, I think this comes back to your earlier point around equities and how the notion that somehow the Fed is going to lower rates a ton on this and that's going to be great for stocks. And we have to think about the discount rate, as you alluded to. It spreads into, there's plenty of studies out there that are now coming to light, or some more recent ones, that inflation expectations, actual inflation, tends to rise when you have independence of a central bank threatened. There's very hard evidence of that. So the direction to travel here for me is quite clear. And we're already, let's not forget, we're going into this with inflation above target and already at risk of becoming unanchored before the independence concerns.
You said that rates going down positive for stocks is misguided, and that is what we saw on Friday. We've seen a little bit of that unravel yesterday. Stocks did retreat a little bit. But what do you think the moment of reckoning will be when markets do start to decide, come around to your view, that actually if we are seeing the Fed cut rates into an environment where inflation is still so uncertain and potentially could rise and stay higher from here, what's going to be the catalyst for that change?
Well, I think maybe two things. One would be a long end, as alluded to earlier, and if that starts to become unanchored. But the other thing is also maybe a realization that actually the Fed probably won't cut rates that soon, right? Powell's in here for almost another year. Cook is probably going to stay on, get an injunction. It's not going to be immediate rate cuts. And I think we have this Fed independence concerns, inflation rising, actually without the Fed cuts coming as quickly as markets seem to hope.
Can I shift gears here to Europe? Because we had a pretty big story yesterday break out of France with the Prime Minister calling for a vote of no confidence on September 8th. This story has been brewing for some time now, so overall it's not a surprise, but I think the timing took investors by surprise. It's pretty rare to call French lawmakers back from their August holidays. We have seen French bond yields tick higher from here. They're closing in on Italian bond yields. What do you think about the outlook for French assets given the political uncertainty?
Well, it's not great. And I think part of the issue here is that European equities, the euro itself, have been a very popular momentum trade throughout the year, right? And so what we're seeing, I think, in the last couple of days has been a little bit of some of the unwind of some of the momentum trades that have been working, not just in Europe, but elsewhere. And so there's the risk there that we have seen a further unwind on some of these political concerns. I don't know that Bayrou is definitely out. There's still some uncertainty there. He's got a lot of things he can offer the opposition, including talking about French holidays. He threatened to take away some public holidays. Certainly that's going to be taken off the table. So it's not a done deal, but they're walking a very fine line here. And as I mentioned earlier, given where market positioning is in European assets, there's a lot of risks.
It seems like, even if, as you say, it's not a foregone conclusion that Bayrou is out, it seems like it is likely, but not a foregone conclusion. It still makes policy reform and actually getting the policy agenda through look much more complicated. So what does that mean in terms of the attractiveness of French assets versus other European assets over the next couple of months?
I think that the direction to travel there is pretty clear, right? I mean, Germany certainly is the positive story, but away from that, looking at economic growth in places like Italy, Spain, they've been chugging along very nicely. In the background, with all the negative focus on France, Italy's done a fantastic job of adjusting some of its primary deficit and getting that house in order. So I think it's just going to continue to be France versus the rest of Europe for the time being.
So just a quick question on the long end of the US bond curve, so the 10-year to the 30 on the US bond market. I keep hearing don't go into the long end from various analysts, but I look at the 10-year now, it's only at 4.3%. It is nowhere near the level where the bond market starts sending out signals, which the administration starts pricking up its ears and going, okay, maybe we need to pull back on something as well. Why?
Well, I think probably one of the most popular trades this year has been the yield curve steepener, right? I mean, more so probably in something like 5-year versus 30-year, not necessarily 2s versus 10s. I also think that maybe the 10-year is not fully representing those Fed independence concerns. It's probably more the 30-year. You look at the 10-year versus 30-year, that's steepened out a ton this year. So I think that the trade is already somewhat on, and that's part of it. And to really see a full proper unwind of some of these bond positions, I think you need to see funding markets become a little more unhinged, and that's a risk still, given the Fed is doing QT. We're seeing reserves fall. So the jury's still out on the long end, right, in terms of a bigger, more unhinged move.
Brilliant. Eric, lovely to see you. Thank you for covering these stories for us. Eric Nelson, who is macro strategist at Wells Fargo. Thank you, sir. The president has also threatened to impose additional tariffs on countries that have digital taxes unless they scrap the legislation. The US leader referenced Europe in a post on Truth Social, saying the taxes had been a long-standing trade irritant for multiple US administrations. Separately, Reuters is reporting the White House is also considering imposing sanctions on the EU or member states that implement the bloc's Digital Services Act. Hang on, I thought the EU thought it had a deal with Trump and that they'd got away with this and there was no focus on the DSA. Now, it clearly isn't the case. Elsewhere, the president has warned of a 200% tariff on China if exports of rare earth magnets are curbed, threatening the precarious trade truce between the world's two largest economies. Elaine joins us with more. Elaine, good to see you.
Hey, Steve. So this brings U.S.-China trade tensions back to the fore as we inch towards that new November deadline for the truce and as trade talks resume reportedly in Washington this week. So there's a debate about the White House's approach tying these tariffs with critical technologies, which critics say complicates the U.S.'s longer-term strategic planning. But Trump's comment also comes just days after Beijing announced new rules over the volume of rare earths basically giving them meticulous control and being able to track all the rare earths product flows in real time and to enforce that strict control over the entire supply chain of rare earths in China. Now, Trump said if China doesn't give the U.S. magnets, they could face 200% tariffs, quote, or something. So Wall Street and political analysts have told me that they sort of see this more as just something Trump says, because he did modify it with 200% or something. But the comment also highlights the country's dependence, including the U.S., on rare earth magnets, the processing of which takes many, many complicated steps and which China has the greatest dominance on, Steve.
Elaine, lovely work. Thank you very much indeed for updating us on that story. Well, our colleague stateside will be speaking yet again to the US Commerce Secretary Howard Lutnick later today. Catch that conversation at 1 p.m. London time. I wonder if I'll ask him about his comments about the Chinese aren't getting our best chips, they're not even getting our second best, they're not even getting the third, and we want to create a dependency as well. I wonder if they'll ask him about that. I hope you do, dear colleague stateside.
I hope so as well. Coming up on the show, Germany's chancellor calls a cabinet meeting to discuss domestic reforms, pushing for changes to the country's welfare system. Plus, President Trump says his deal to secure an equity stake in Intel could be the first of many. And we'll discuss the impact of U.S. tariffs on Switzerland with the CEO of chemicals company Clariant. Don't miss that conversation at 8:30 London time. Welcome back to the program. Let's get back to one of the biggest stories in the market that emerged yesterday. French Prime Minister Francois Bayrou has called for a confidence vote at the beginning of next month over his budget plans, taking a gamble which could risk the fall of his minority government. Several parties, including the Greens and the Socialists, have indicated they will vote against Bayrou, with the far-right National Rally leader Jordan Bardella saying the Prime Minister had in effect announced the end of his government. Bayrou is seeking support for his unpopular €44 billion budgetary squeeze for next year, which he says is needed to reduce the country's deficit, which stood at 5.8% of GDP last year, almost double the official EU limit. During the announcement, Bayrou stressed the need to tackle France's ballooning debt.
I say this with certainty, with belief and the utmost sincerity, that this is not France. It's not about chaotically bringing France down. It's about building her up through courage and generosity. That's why, as we return from the summer recess, we need clarity. Is there or is there not a national urgency to rebalance our public finances and to finally rid ourselves of the curse of debt overhang?
In terms of market reaction, overall, this was not a surprise, but the timing certainly did take investors by surprise yesterday. Very unusual to hear that the French government would call leaders back early from their holidays in August. This no confidence vote now due to happen on September 8th. And we did see a sharp underperformance in French equities yesterday. We also saw yields move higher. Right now, the French 10-year trading around 3.49% or so. In recent weeks, as this story has brewed, we have seen the spread between BTPs and oats narrow to historic lows. This, of course, as Italy's financial situation has improved. So factors on both sides here, but certainly an area to watch over the coming weeks, these French assets.
I'll just put in here, how long do the French typically take off in the summer? And it just says here under the first thing, July and August. I just get 8.5 weeks off. That's just, July and August. I mean, most of us get 2 to 3 weeks if we're really lucky. Yeah, I'll just take July and August off.
I think that's why this came as a major surprise yesterday. The news itself was not surprising. We've been talking about this story for months now.
The French have political chaos because their president a couple of years ago made the stupid error, the catastrophic error of going to the country to elect a new government, and actually, funnily enough, didn't get the majority and it backfired. And since then, we've had confidence vote after confidence vote, Prime Minister after Prime Minister.
Yeah.
Oh, okay. Got it. Moving on, German Chancellor Friedrich Merz has called a cabinet meeting to discuss domestic reforms. It comes after the Chancellor argued for a reassessment of the benefits system, adding that German welfare is no longer financially sustainable. Annetta, Absolutely. We talk about welfare systems that are unsustainable in all the major countries. It is a fact as well. But the problem is when you're in coalition with the Social Democrats, does it become a bigger problem?
Yes, I think it's a fair summary, but let me bring you back to the wider perspective. So the social spending actually has reached a record level for 2025, that current budget at 190 billion euro. And the contested issue is the so-called citizens allowance or citizens benefit, which was enacted by the Social Democrats in 2023. This is essentially more than just unemployment benefits, because you are allowed to apply for it if also your salary is not enough to cover your living expenses. So you get rent subsidies, you get all sorts of subsidies. And the CDU is arguing that there's like literally not enough incentive to go to the labor market, at least for jobs which are not very well paid. So we have a scarcity of labor in especially that segment of the market. And of course, the CDU is arguing that's because the allowances are so generous. So the Bavarian Prime Minister Söder, of course, very much conservative and rather to the very conservative end, is calling for scrapping that citizen money altogether, going back to the old system of unemployment benefits, which actually would mean 50 billion euro less in spending per year. Currently, the big issue is there's a huge gap in the budget. I think it's like 30 billion euro missing for this year, and they need to find that money also in order to give more subsidies to the economy, for example, to lower energy prices. So what Friedrich Merz has promised is an autumn of reforms. Remains to be seen how far he's going to get, because as you were rightly pointing out, he needs to get his coalition partner on board, the Social Democrats. And now the idea has been floated. There could be higher taxes for the rich, which means higher taxes for the highest bracket, which starts at 250,000 euro per year for single households. And then there could also be higher inheritance taxes. So that's where we stand right now, higher taxes for the rich. And that's the bargaining chip for the Social Democrats to actually look into reducing social spending.
God, it's like cut and paste at the moment. You could be in the UK, you were talking about there. Redistributive policies as well, tax the rich and blowing up the inheritance tax. Well, I felt like we were back in Westminster, Annetta. Lovely. Well, it's nice to hear it's not just us who have got all those issues as well. Thank you very much indeed, my friend. Well, talking of the UK, shop prices rose at their highest rate since May 2024 this month, up 0.9% on the year, amid a food price jump of more than 4%. That's according to the latest figures from the British Retail Consortium, which come amid warnings from the Bank of England that food price inflation is driving up broader inflation expectations. In a statement, the British Retail Consortium chief Helen Dickinson said the £7 billion in new costs flowing from, last year's budget had created an uphill battle for retailers. This following a raft of headlines bemoaning the state of the UK economy. But data is beginning to come through, suggesting conditions may not be quite as stark as feared. Oh, Ritika, good morning to you, my friend.
Good morning, and I could see your face, and I thought, just hold on, Steve, let me get to it.
The viewers know how cynical I am, and
Yes.
most of them despise my curmudgeonliness. But anyway, you are wearing green, and you're talking of green shoots.
I am. I'm optimistic today because, we've been talking about the doom and gloom about the UK economy for months now. So it is a nice change, shall we say, to see some signs of life for the UK economy. And I'm not saying that we're turning a corner just yet. We're not out of the woods, that is certain. But if you do look at some of the recent data points, GDP, for instance, that came in better than expected, up 0.3% for the month of July. You look at payrolls data, we added 238,000 jobs for the 3 months to June. And also, there's a lot of optimism about the private sector activity. That has been expanding at its fastest pace in about 12 months or so. And consumer confidence levels, those are starting to get back to levels that we saw at Christmas before the trade war tensions all came in. So it does suggest a few things. Maybe one thing is that Rachel Reeves' tax hikes that came into effect in April, maybe they're not having as bad of an impact as thought on the economy. And why is all this important? Well, we have the autumn budget coming up, and this all impacts the black hole that Chancellor Rachel Reeves could be looking at. Some who are very pessimistic on the economy, saying that could be as high as £50 billion black hole she's looking at. But there are a lot of people saying, wait, that's... I've spoken to economists, Steve, who are actually much more optimistic, and they're saying that black hole is
it might only be 35 billion.
No, I mean, it could be, 10, 20, so
right.
Still... So it's all relative, right? But
do you know what? I'll let her... I feel that I am in the crosshairs of every single government that runs out of money at the moment. I pay every single penny I pay in tax. I pay it all by PAYE. I don't live overshores. I don't have overshores money. I don't have trust funds. I don't have anything hidden away anywhere. I feel like I'm in the crosshairs every time they run out of money. That's why I'm kind of personally and professionally just thinking, here we go again.
And if you feel that way, think about the people who are in the non-doms, the people who are facing potential.
To be honest, I'm less worried about non-doms. As much as I don't like the fact that these people are leaving our shores, because I think they generate wealth and I think they generate income. The fact of the matter is, they've got enough money not to worry about it as much. I'm just a normal guy working a normal job with PAYE.
Yeah, and that's where we get to the more negative side of it, which we were always going to get to. So a lot of people warning that this is just cyclical growth. It's not structural, and that the underlying elements of the economy, GDP or productivity, that is the engine of the UK economy, and that has been remaining sluggish.
Well, speaking of productivity, I think one of the most alarming stats that we talked about yesterday, Andrew Bailey highlighted, which was the labor force participation rate, in particular from young people, that here in the UK we're seeing a major drop in participation. What can you tell us about what's going on there?
So that's an interesting point, because at Jackson Hole, this was quite sad. He called the UK situation a sad story. He said there was weakening growth and at the same time a shrinking labour force, and then highlighting that lower participation rate that you were talking about. And this comes at the same time when we have an inflation rate that is close to 4%. So the Bank of England's hands are tied to some extent as well. That they aren't able to cut rates as aggressively as they perhaps would have liked. And so that means that doesn't, those who are expecting rate cuts, we might not get them. That's not a done deal that they're going to happen as soon as maybe hoped.